must understand people now ain't built like me. Lying through their teeth is not a problem, but it is for me. Even though I'm alive, it's inside where I feel deceased. I put my trust in someone else and now I'm about to free the beast. I did it once and I won't never again. People take kindness for weakness and try to hide what they can.
Mr. Prez here, back for another episode of Technical Analysis for Beginners. This one's going to have a little bit of option talk. Today we're going to be talking about the VIX, the volatility index, and how you can use it to nail some of those SPY day trades, those SPY option scalps. So the VIX is a pretty good tool to scalp SPY options intraday. It's a good tool to kind of give you an idea of when you can see increased volatility in the markets, when you might start seeing the indices pull back. I use this a lot when I trade options. I always have a quick chart of the VIX and the SPY, one on top of the other so I can inversely watch them. So the VIX measures the put to call ratio in the market. So basically, I'm going to keep this as layman terms as I can. Essentially, whenever the VIX is high, fear in the market's high, which makes the premiums on your options higher in turn. So it's going to cost more for you to buy your puts. It's going to cost more for you to buy your calls because the market makers are implying more volatility, those higher ranges of movement. Typically, the VIX is going to be inversely correlated with the SPY, and that's kind of how you can use it to your advantage intraday. When you start spotting those divergences in the VIX and the SPY, and so on and so forth. So getting right into it, think of the VIX as a visual way to see the fear in the market. So if we go back to the weekly, a super good example of the VIX is you can see back in 2002, to the 2000s, you've got the dot-com bubble. The VIX hits highs of like 48 two or three times during that period. And then 2008, you've got the financial crash that happened. VIX shot up to never before seen highs of 89, and the VIX has a pretty long and complicated math equation that's used to figure out, the formula. We don't really need to worry about that. Historically, a low on the VIX is between 9 to 13 in the last decade or so. This is where you're going to see your options at their lowest, most, fair price, I guess you could say. So the VIX isn't technically, an equity ticker that you can just, it's not like tangible price action. There's no volume on the VIX. But, when you have data that can form itself with a high, low, open, close, you can still plot it with trend lines and this and that. And the patterns work just the same. As you can see on this, starting October of 2018, the VIX kind of did this descending triangle formation, which ultimately led, this thing formed for 2 years. And the one catalyst that finally got this thing to pop was the coronavirus COVID-19 issue. So one thing that you use the VIX when you're doing your analysis for is you kind of get a gauge of where the market is in terms of complacency. Historically, like I said, when we're at those 9 to 13 values, that's when you have complacency in the market. So you'll notice you notice things like during the coronavirus run up, whenever all this volatility came into the markets, SPY was having circuit breakers every day. Um, and then since March, we've kind of, made a full rebound. But what you'll notice is, and I marked this, it's always important to mark pretty, geopolitical major events, this and that on your VIX chart. This is the COVID gap down here at 22. And you'll notice that despite, pushing into all-time highs, the volatility gauge, the fear gauge has not really allowed the values. I'm just going to use price action for lack of a better term. It has not really allowed it to fully fill this gap that was created, you know, um, since the coronavirus. So it makes you think about if if we're making these all-time highs and things are just peachy and dandy, why why aren't we going back into complacency? It's because everybody knows that, in some form this is a load of crap that that we're up here. So there's a lot of uncertainty in the market, and you can kind of visualize that with the VIX. And the whole point of today's video is to go over how you can use the VIX to trade SPY and kind of get these movements down. So if we go over to my flexible grid on Thinkorswim, um, you can kind of you do your TA, you do your regular, patterns of this and that on the VIX, and you'll notice I had a breach over one of my key weekly levels, standard breakout. And what happens with the SPY? You have that drastic pull down. So what I like to do is I like to use this mostly on my 10-minute and 5-minute charts, intraday. I still look at my higher time frames at the beginning of the morning. So you go down into your 5-minute chart, and we'll start with the beginning of the day. You've got this consolidation on SPY, just choppy back and forth right at the bell. Um, so you go down to your VIX, and it's the same thing. You've got your choppy open, but then you'll notice you've got this push up into this key level. You've got your bottom, and then this push up into this 27.75 level. And as soon as that happens, you get this breakdown on SPY 355.78 down to, it's a 3.75 move off this little breakout on VIX. And then, just keep following the price action. What happens? You start consolidating. You've got this box range on the VIX. And then what happens at SPY? You've got a consolidation period on the SPY as well. Whenever VIX breaks out of this consolidation at, the candle at 10 o'clock, if you look at the VIX candle or the SPY candle, sorry, at 10 o'clock, look what happens. So whenever the VIX breaks out upwards, SPY is breaking down. Does that make sense? And just a couple of ways that you can use this as well is after that move down on SPY, you have this bearish. This is kind of like an exhaustion move, exhaustion candle in VIX. VIX might pull back, which means SPY might do what? SPY might bounce. So at 10:20, you've got this candle right here. So let's check out what happened at 10:20 on our chart on SPY. So as soon as you get this bearish candle on the VIX and VIX starts to pull back, you immediately get your bounce on the SPY. And you can pair that one step further because what do you see right here? Exhaustion selling. At the end of this extended move lower, you have this exhaustion volume. So that's two areas of conviction right there. And if you needed another, you've got a breakout, bullish buy volume. So we'll keep it going. After this descending triangle breaks on the VIX, what happens? So at 11:20, let's see, we'll move the price action. So at 11:20, the descending triangle on the VIX starts to break, and at 11:20, the SPY, what happens? The SPY breaks down again, and they'll say you took the short under the break of this, because technically this is where you should be shorting under 347.45. VIX breaks over this key level of 31. Let's see, and you go down to 340. So that's another 3 points on the SPY on a 5-minute VIX breakout. Another super important thing, real quick, before we finish up, is divergences in the VIX and divergences in the VIX and the SPY. So basically, what that means is if you notice the VIX going up with SPY, because they're supposed to be inverse, right? So if SPY is going up and VIX is going up, this might tell you that SPY is prepping for a correction soon. And vice versa. If VIX or if SPY is going down, VIX is going down, it might be trying to clue you in that, hey, the reversal's coming. All right, guys. Uh, Thanks for tuning in to another episode of Technical Analysis for Beginners. See you guys next time.